Hello, I'm Jackie Lucky, your financial planning maestro. This series of podcasts is aimed at financial planning professionals and also those who are looking to enter the financial planning profession. We will be talking during the podcast about all things Certified Financial Planner certification related, talking to other CFPs around the world, and also we will be dropping in on some new entrants who've just entered the financial planning profession, and we'll be checking up along the way on a regular basis with them to see how they're getting on. I hope you enjoy today's podcast. Hello and welcome. I'm Jackie Lucky, your financial planning maestro. And today we are talking all things CFP related and assessment related for those going through the CISI Level 7 assessment. And I'm joined by an ex-CFP case study assessor, and that is Gareth Tregidon from Nugenis Financial Planning. Welcome, Gareth.
Hello, Jackie.
Thanks for joining me today. Now, we are going to dive in. I've got lots of questions to ask you about everything to do with the financial plan assessment so that we can give people as many tips as we can in the time that we've got available to help more people pass.
Sounds good.
So, before we get into the nitty gritty of the sorts of issues that you found in your days of assessing, let's just go right back to the start and tell me a little bit about how you found the CFP and when and why you decided to embark on the CFP certification.
This goes back into the depths of history. I met a few members of the IFP when I was a financial advisor. I'm picking my words carefully. They got me into a couple of the meetings, found out about the CFPs from that, and as a lot of your guests have already said, decided that was the way I wanted to go. Thought it was a much better way of working, more ethical way of working, if you like. Yeah. And it led on from there. And I was, at one point, I changed employer and thankfully had a choice of offers, one of whom was a CFP. A chap called Derek Parry. Went to work for him, learned all about Prestwood, and it went from there.
Oh, and that was a little while ago?
Yes. I actually passed my CFP on the 31st of January 2000.
Oh, so only a few months after me. I passed end of September 99.
Right, and I only know because on some of the old IFP certificates, it actually had the date you passed on there.
Yeah.
I can't find, and I don't think I ever had my first certificate, i.e. the bit of paper, but I did find the second one. And I've got every certificate since. No idea why I kept them.
It must be a CFP thing, because I've certainly got every one of mine as well. So you're not alone in all of that.
Oh, thank goodness for that. That makes me feel better now. Yeah.
And so tell me, how did you get involved with CFP assessing? Obviously, once you passed your CFP certification, back in, the early 2000s, it wasn't always a case of, the IFP just writing to you, was it? And saying, do you want to be an assessor? How long was it from when you passed your CFP to when you got involved with assessing?
I started assessing, it would have been sort of mid-2006. My first submission that I sent back was 4th of October 2006. And yes, I did keep a note of what it was. Basically, I'd kept all the everything I'd sent back, all the assessments I'd done, they were all on a spreadsheet. I just happened to come across the spreadsheet, so that was the earliest entry on the spreadsheet. And there's something that is just short of 600 submissions I've marked.
Wow. Yes, so, I know that feeling. I think my tally is up to about 1,000 because I used to do all the first submission assessments at the IFP when I used to work there as the Director of Training and Education. So, a few ahead, but that's still a mountain's worth. And they take quite a long time to assess, don't they? How long did they take you? I mean, they used to take me about 3 to 4 hours.
Oh, comfortably, yeah. And I remember going to an assessor meeting probably a few years after that. There was a couple of people there say they were doing them in 2 to 3 hours. And I never understood how. And then I found out after that they didn't last long as assessors.
Okay.
But most people, and particularly in those days on the old system, the level 6, comfortably, 4 to 5 wasn't unusual, 4 to 5 hours.
Yeah. Yeah. And so for people taking the new CISI level 7 case study assessment, that's where the majority of the costs that they pay for each submission, is going to pay the assessors, because, it nearly wasn't quite minimum wage back in the IFP days, but you used to get paid a very small amount of money, didn't we, for
absolutely,
for 4 or 5 hours work. It's You don't do it for the money. You certainly do it to put something back into the profession, don't you?
Indeed. Yeah, very much so.
Excellent. So let's talk about, your experience having seen, 600 financial plans and spent 4 or 5 hours per plan, going through everything in minute detail. Just give us an overview to start with. If you were assessing now, I know you've recently stopped, so we can talk to you about this kind of thing.
But I was going to make that point. Yeah.
Yes, absolutely. Same as Joe, who we spoke to. Same rules apply. You're not a current assessor, so we can talk to you about how your approach. So just give us an overview of broadly how you would approach assessing a financial plan if it dropped on your doormat.
It's very similar to Joe, because I listened to the podcast you did with her a couple of times. When the plan first arrives, it's all electronic these days, first thing you do is read through it. You get a sense straight away whether someone is a planner, and I'll come back to what I mean by that in a second, or whether someone has gone through a lot of CII exams, for want of a better example, and just feels this is another exam. Yeah. So I'll go through and make some notes. Again, as Joe said, the assessors all know the case studies inside out because they've seen them time and time again. I mean, some of the case studies, some of the stuff I've done for CISI in particular and IFP before, I've written some of the case studies and sort of second assess them before the candidates ever see them as well. So we know what we're looking for as an assessor. You know the immediate things to spot. You'd look at the kind of approach taken. And does it make sense? And then I'll go back through it with the marking sheet on one side of the screen with the standards on it and go through the detail. Yeah.
Do you have particular sections that you always used to look for first? I know I always used to look at the assumptions section first.
I had a funny feeling you were going to mention the A word because we've had several conversations on this, and I'm of a similar mind. The assumptions, in some ways, the move from level 6 to level 7, where the candidates are now given the assumptions, in some ways that's a lot easier for the candidates. In others, it's more difficult because they haven't come up with these themselves. You haven't got the same buy-in that you had previously.
Yes.
Or perhaps buy-in's probably the wrong word, but if you create these yourself, you go through the rationale yourself, you understand them better. Yeah. And some of the things we used to see, the inflation assumption is key to everything because it not only affects projecting forward figures, for example, or the other way either, but things like the investment returns, it affects every aspect of the plan, really. Yes. And the example, the assumption given is CPI. You will occasionally have case studies where CPI is the wrong inflation measure. Yeah. So you've then got to come up with a rationale for using RPI or whatever else you may use. Yes. And, it's really interesting. With the courses that I've been running, everybody thinks that the assumptions that are given to you by the CISI are all the assumptions that you need. And of course, I think I added another potential. I set them all out in a list just for the hell of it, as it's my favourite subject. And I think there were an additional 12 potential assumptions that you could add. Yes, at least. And again, it depends on, A, the case study, obviously, and the client scenario, but B, the way you approach the plan and what you come up with from the plan. Yeah.
Yeah. And so the assessors over the last few years, the assessors have issued several documents, haven't they, offering tips and hints to candidates sitting their level 7 case study. So, I want to delve around in a particular one that I certainly am seeing that is a particular issue for lots of people, and that is retirement planning.
Right. Yeah.
And I think that, the school fees, or in some case studies, I think it's a charity donation. It's, the short-term funding objective is relatively straightforward to sort out, isn't it? You could do it essentially, it's a straightforward time value of money calculator job, or a little Excel spreadsheet.
And there's more of a defined duration for those things as well. Which is obviously a big part of that.
Yeah, but what I'm seeing now is that the retirement planning, some of the case studies are a lifelong cash flow, where essentially, the clients have sold their own business and they don't want to go back to work. So they're kind of retired now. And some people say to me, well, when I'm building my Excel spreadsheet, I don't know what to do for retirement planning. And I say, well, your Excel spreadsheet doesn't know that it's retirement planning, does it? It's just running the numbers. You've got to think it through, that these clients in that scenario, if they've sold a business and they don't want to return to work, they're kind of retired now, aren't they? And so your spreadsheet just reflects that, and that the assets they have and their investments need to fund from day one, essentially, is their retirement date, rather than at some known point in the future. You're funding it from the first day, and there just seems to be this huge speed bump that is the retirement planning section, where people, I think maybe it's because where the assumptions coming in, it's using those assumptions. I get questions like, well, I don't know how to set an annuity rate. Can I just use a current annuity rate? And I say, well, maybe, but not. Again, it's going through that methodology, and how does the annuity rate fit into the assumption for gilts and corporate bonds that the CISI has given you, for example? So it's tricky. This is a particularly tricky section, isn't it?
It can be. I think part of it is the word retirement seems to stump some people, particularly when you're not talking about somebody at state retirement age, which is what a lot of people who've been in this industry a while think of. Let's say 60 plus, that's when you retire. Whereas if you've got a business owner, to use your example, that could be 40, it could be 70, it could be anywhere. The age is irrelevant. It's retirement is not working in terms of the plan. And then you build, so almost ignore the word retirement and just say, well, right, from such and such a date, depending on the case study, you need to generate an income to cover what you've told me you want to spend. And then you go from there. Yeah.
And it just seems that one of the things that I see fairly regularly is this a disconnect between using real rates, or understanding of what a real rate of return is and what a nominal rate of return is.
Yes. And we've had discussions amongst the assessors, and I'm sure you and I have talked about this in the past as well. I think there's a generally a poor understanding, and I am generalising, of how important it is to distinguish between the two. And I've seen very good plans based on nominal rates, and then projecting forward and then discounting backwards to account for inflation. And equally, I've seen very good plans using real rates from day one in terms of returns and everything else, and doing it that way around. There is no right or wrong way of doing it, but you need consistency throughout.
Yeah.
And it's, I think for the candidates, it's deciding which one you're most comfortable with. Some candidates seemingly looking, just bear in mind, all I'm going by is the plans that are presented, struggle to get their head around real returns and the impact and the need for that consistency throughout.
Yes.
Whereas others, adapt to it quite comfortably. So I think it's a very personal thing. From an assessor's point of view, it just needs to be really clear which approach you're taking, and then, as I say, be consistent right through the plan.
Yeah. So let's just stop there and talk about what we mean by real and nominal rates of return. What is a real rate of return?
In very simplistic terms, it's the current rate of whatever it is you're talking about. So let's say it's equity returns, just for the sake of argument, or an investment return. Let's be even more general. So if you're saying this portfolio that I put together for you is going to average 5% a year, if you're going to project that forward, you need to account for the effects of inflation. Because if your portfolio is generating £100 worth of income today, that £100 in 5 years, 10 years, 20 years' time is going to be worth a different amount.
Yes.
So you need a method of adjusting that, so that if you're projecting forwards, retirement is a good example. In some cases you're doing 30 or even 40-year projections. Well, the value of a pound in 40 years is going to be very different to the value of a pound today.
Yes. I always talk about it in terms of buying power, what you can buy with a pound today and what you can buy with that same pound in 40 years' time. Completely different amount.
Absolutely. You talk to anyone, I speak to my parents, and my mum in particular quite often says, oh, well, back in my day, and that's the way the conversation starts, for this, it would cost you a fiver and you just still have change. Whereas today, you can't buy anywhere near that. And it's that same principle, but it's just applying it to financial calculations.
Yeah.
And then it's, from a candidate's point of view, it's understanding how to do that as well. Because this is the other thing that comes up quite often, is how do you convert? So if you've got a series of figures or returns or whatever else you're looking at, some are nominal, some are real, how do you adjust one or the other so that they are all the same?
Yes. And there are two ways of doing that, aren't there?
There are.
The arithmetic way and the geometric way.
Indeed. And it's amazing how many conversations I've had with people over the years who just can't get their head around the difference. And again, it's about clarity. There is a mathematically correct way, and there is a way, I would argue, most of the general public would do it, and they are different.
Yes. Yeah. So some people just take their investment growth figure and then just deduct 2% or whatever it is for inflation. That's the arithmetic way of doing it. And then the geometric way of doing it, for those people who have attended my courses will know the geometric way of doing it, because we use a formula called the Fisher equation, don't we? And that essentially gives you the compounded effect of that rate. So it removes the monthly effect of the 2% inflation rate.
Exactly. Yeah. Or as I think it may have been, your husband said, the proper way and the other way.
Yes. Absolutely. Yes.
Yeah. The general public think subtraction, addition and subtraction, whereas mathematically the correct way to do it is multiplication and division, which is the Fisher method, as you say.
Yeah, absolutely. And then the other method of doing it is nominal terms. Just explain briefly what that is.
So basically, to use your example, if you take the current return or the current value, apply that throughout, you come up with a projected, let's say, a fund value. You can then discount that back by the rate of inflation. And there are various ways of doing that. Excel is an easy route because there's a formula on there that you can use to do that.
Yeah. So essentially, in nominal terms, we're saying if a client... So in real terms, if a client wanted to say, I want to retire on £40,000 a year in 20 years' time, then if you were doing it in real terms, your calculations at the end of your spreadsheet would show £40,000 because it's 40,000 of buying power, isn't it? But if you were doing it in nominal terms, because it kind of includes the effect of inflation, then you would first have to calculate what the buying power in nominal terms of £40,000 would be in 20 years' time. And that might be, I don't know, £60,000 or whatever it is. And then in your spreadsheets, you're actually projecting an income of £60,000 because you're including the effect of inflation.
That's it. Yeah.
And it can be really easy if you're new to looking at real rates of return and using them in spreadsheets to actually mix up the two. And we've seen lots of cases over the years where some bits are in real, particularly in retirement planning. There's a bit of both going on in there, isn't there?
Yeah, and that's the bit, this is what I said earlier about clarity. When the assessors are looking at this, the easier, I think you've said this in previous podcasts, the easier you can make it for the assessors, the more likely you are to be given the benefit of the doubt if there is a 50-50 decision to be made. So if you can show you know what you're doing, and it's clear which approach you're using, you're far more likely to get a positive outcome.
Yes. And actually, I think it makes getting that clarity in your head, I don't know about you, but certainly I think it would make it easier to have that conversation with clients, with real clients, after you've been through this process.
Yeah, we talked about how long I was assessing for. The reason I kept going for that long really was I benefited from the assessments in my day-to-day life. So it informed and it changed the approach I took with clients. So what I do now is based on X number of years experience, but it's also based on the experience of assessing the plans and seeing the approaches people took to planning, albeit that was a case study and I've applied it to real life.
Yes, yeah. And before we move on away from the retirement planning area, there's one particular thing that I always used to see when I was assessing many moons ago, obviously now. I just wanted to see whether you saw that more recently with the level 7 case study assessments that you did. And that is that in the retirement planning section, lots of people didn't take into account the effect of tax in their recommendations. So they took it into account on the way in, but not on the way out.
Yes, absolutely. And again, this is where the real and nominal issue arises again. I've seen quite a lot of candidates would make an assumption around how much tax would be deducted. So they would pick a figure of, say, 18, 19%, but there'd be no rationale as to how they've arrived at that figure. Bearing in mind, when you're working, you've got NI as well as income tax, whereas when you're retired, you haven't. So the tax position changes. It should be relatively easy on a spreadsheet, particularly, to project forward an assumption for how much personal allowance is going to be. Are there any other taxes that could have an impact? CGT, for example, if the returns are from investments. It should be relatively straightforward to do that. Or you just go for if you go for the nominal approach, you project forward what the current personal allowance is and by the inflation rate you're using, and then you apply it and then you discount it back as well. So there's various ways of doing it, but just make sure you do it and make sure it's clear how you've approached it. Bearing in mind, as we've said time and time again, I'm sure you have, the one thing I'll guarantee with these assumptions is they will be wrong in the real world, because I've got no idea what inflation's going to be next year, let alone in 2030 years' time.
No.
Let alone allowances and tax bands and everything else.
Yes. And that's one of the things that I was used to see with assessing is that it would be down to the exact penny. And it would be like, £200,000, £200,163.29.
Exactly.
Approximately. Approximately, yes.
Yeah.
There really is no need. I think certainly my husband, who's a financial planner, he calls it spurious accuracy because it clearly isn't going to be that. So from an assessment point of view, that's not really necessary. You can just round it down.
And assessors won't be checking that level of accuracy. They'll be checking, is it reasonable? So if the figure you've come up with, based on how you've laid out how you've got there, so the methodology, is that figure reasonable?
Yeah. One of the questions I often get asked on my courses is, do the assessors actually check all my spreadsheets? So perhaps you're the best place to answer that question.
I can only talk from personal experience. And again, it comes back to this looking at it and does it look reasonable and is it well explained? I have quite often checked spreadsheets. Because you get a feeling, you look at this and you say, well, right, we're starting off here. This is the figure that's being projected. It doesn't quite feel right. So we will check calculations.
Yes.
One of the classics with retirement planning, the two elements to this. One is, to my knowledge, certainly when I was assessing, none of the case studies mentioned salary sacrifice.
Nope.
So in retirement planning, candidates will quite often say, and I'm assuming that your employer will allow you to do salary sacrifice, but there's no mention of it in there. Now, they may well do in the real world, but in case study world, you can't make that. That's not a reasonable assumption without some form of justification.
No.
And the other one is the frequency of contributions. So if you're saying, well, right, to achieve X, you need to put Y into your plan per year, and then they'll assume an annual in advance contribution from the employer, for example.
Yeah.
It's not reasonable. And it does, over a prolonged time period, it will make a difference to the calculations, and quite sizable differences in some cases. And that's your point about the spreadsheets. Quite often you'll see annual in advance contributions, and you know that a 30-year projection is going to be wrong.
Yes. Yeah. And things like state benefits as well in the retirement planning projections. Lots of people might add in a few, miss out a few, or say even worse, we assume you don't get any, when clearly you're going to get some.
Yes. State benefits was always a classic where you knew if someone understood what they were talking about. And that would be exactly what you've just said, which is, I'm assuming you're not going to get any because none of them are guaranteed. Well, and that would be it. That would be the whole justification. And it doesn't wash.
Yes. So everybody out there who's creating their submission at the moment, don't do that bit.
No,
Think it through.
Exactly. You can make some reasonable assumptions around state benefits. Nobody's expecting you to be a state benefits expert. The system is hugely complex. There are experts out there, and that's all they do. But just make some reasonable assumptions around it.
Yes, absolutely. Okay, let's move on from retirement planning then and talk about some of the other common areas that as assessors we've come across in the past. And one of them that is actually on that sheet of tips that the CISI has issued is a common thing that we've seen over the years of the candidates not explaining the impact or potential impact of underwriting on the financial recommendations they're making for clients.
It amazes me because in the real world, you'd have that conversation with the client. And yet, even though it's a standard, it's a very explicit standards, plural, quite often it's not dealt with at all. One of the old case studies, I don't know whether it's still in existence, mentioned it was a couple and one of the partners had health issues. You have to address it. Because not least, in reality, you would address it because it can have a huge impact. But purely in terms of the plan, if you're applying for life or health insurance, if there is a possibility they're either going to be loaded or declined, that will affect the plan.
Yes.
And it not only affects the protection element of the plan, but it'll also affect other areas. If you need to spend more, if it's going to be loaded, for example, and therefore there's a likelihood, as I think it was very obvious in this one case study, if he was accepted, it would have been loaded. Well, that takes more of the income away to pay for that if they still want to go ahead, and is it still affordable, etc. Yeah.
And the knock-on effect of that, of somebody with health issues in the case study, is the assumption for longevity that you still have to make, isn't it? And
that was great. It was quite often they were still going to live to 100, even though in the previous pages you'd said, well, there's a good chance you might be declined on health grounds, which is interesting.
Consistency, you've got to think it right through to the end, haven't you? If you've got somebody with those kind of health issues, and it's not just a case. I know we've been certainly on my last course, we were discussing whether if somebody's got health issues, does that mean that if I look up the ONS stats for the average healthy person lives to a particular age, does that mean that my unhealthy person should live to that age on the basis that 25% of people who are healthy will live longer than that? And you were like, I've got a headache now.
It's with all of these things, what the assessors are looking at is, have you recognised there's an issue and have you come to a reasonable conclusion?
Yeah.
Or to put it another way, there is no one right answer.
No.
So the underwriting, have you recognised that underwriting will happen? Have you explained what that means? Because a lot of clients don't understand what underwriting is and what's involved. Nobody is expecting you to be an actuary. And you don't have full health details. You haven't got the benefits of, again, real world versus case study world. You don't know what an underwriter is going to come back with. So all you can do is explain as much as possible and explain that there could be a potential impact on the plan and the need to review it again, etc.
Yeah, absolutely. And, just that consistency, thinking things through, not just diving in straight away to your case study, which leads me nicely on to the problems that we're seeing at the other end of people running themselves out of time when it comes to hitting that submission deadline. I mean, you've got 10 weeks from the date that you receive your case study, and you really do need to be disciplined if you're doing it in a course. Obviously you need to have that time out of your diary, but also if there is going to be extra work outside any course that you would do, that you're going to have to manage your time and stick to it, because that 10 weeks waits for no man, does it?
Indeed, and time and time again, people who've passed the course, the CFP and assessors and anybody else who's got an interest in this, everybody says the same thing, which is you are going to run out of time unless you're disciplined and unless you start straight away.
Yeah.
And it very much is that. You've got to bear in mind, this is not like writing a suitability report to tick a compliance box. This is a financial plan based on someone you're supposed to have met but haven't actually. So again, if this was a client you've seen face to face, you can bring them up and you can ask the questions, but you need more clarity. You can't do that with a case study. But equally, it's not a compliance report either.
No.
So the approach I've always suggested is read and understand the case study. So get your head around the fact find, for example. So not just the interview notes, but the fact find as well. Feel as if you have actually met these clients, and then sketch out as an outline what you think the plan should look like and what the areas it should address. And focus initially, you mentioned assumptions. Assumptions are key, and keep an eye on that throughout the process, but also income and expenditure, assets and liabilities.
Yeah. How
much money have we got to play with, and how reasonably am I going to allocate that? And that's a good discipline. I remember Joe said this to you as well. The best plans, and I do it with my own clients, the best plans I've seen keep a running total throughout the plan. So you cover one section, you update that total, which then leads on to the next bit. It's great for clients in the real world, but it's also good for the candidate going through this process.
Yeah. I read a case study once that I was assessing where the same money was spent 4 times to meet the client's objectives.
Oh, yeah. It happens more often than you'd realise. And I don't blame the candidates. I mean, in one or two cases, I'm absolutely certain they knew that they were spending it more than once. But in a lot of cases, you just get confused because there is so much going on. Coming back to your point about time management, this is a lot more complicated than I think a lot of people realise until you actually start getting into it. Yeah. And it's very easy to get lost in all the words and the charts and the spreadsheets and everything else that you produce when you're going through this process. Yeah. So hence the skeleton outline. What's it going to look like? So if you like a plan of the plan,
yes,
just outline in your head what I'm going to do before you start delving into the detail.
Yeah. I remember when we interviewed Farida Hassan Ali on the podcast a few months ago now, she said that was the one thing she wished she'd done when she did her CFP, her case study assessment. Yeah. And that was that she spent so long delving about in her spreadsheet, she forgot what the client's objectives were. Yes. And she wished that she'd, nailed them to her laptop or something so she could.
I remember that. Yeah. Yeah. It is very exactly that. This is about meeting objectives.
Yes.
It's not about a fancy looking plan. No. A lot of people will use software to produce a plan. Absolutely fine. But again, it comes back to what we said about clarity. So it's all very nice putting a little bar chart or a line graph in there, and it looks very pretty and it breaks the text up. But if there's no context to it, the assessors are just going to ignore it. But it actually takes more time, and it takes time away from doing the things that you should be doing, which is what are the objectives? Do I understand them? Do I understand where the client's starting from? Right? How do I set that out? How do I decide which bit I'm going to attack first, etc.
Yeah. And that leads me on to talk about the when people run themselves out of time, normally the estate planning section is left till last. And I know that some people haven't actually started essentially the estate planning section when they submit their plan. Quite often what I say to people if they're running out of time is you can't just submit, 20 Excel spreadsheets, you've got to submit some text with it. So there has to be a point, a line in the sand, a date that you can't, a hard stop date where you've got to start writing up that plan. And that means writing everything else that you've got, even if you haven't finished those sections, any particular sections, particularly like the estate planning one, that the ones you have finished the calculations for and you do know what the recommendations are, then you need to put as much of that and do your best to demonstrate that you know what you're doing. So you could pass all of those other sections, even if you don't pass, perhaps the last one or two.
But again, it's this outline plan. If you've got that outline plan, this skeleton, you will we should automatically include estate planning where it's relevant.
Yes.
And bear in mind, estate planning in this context is not inheritance tax planning, because they are very different.
Indeed.
I think from memory, the estate planning standards, I think there was about 16 or 17 of them in total, in which case if you need 51% to pass, things like talking about wills, LPAs, trusts would tick a box. So there's one of your 9 points, let's say, that you need to pass the section. But if you've already got that skeleton, you will get some credit for having started it, even if it hasn't got enough in there to maybe pass the whole section.
Yes.
And then the other thing, as with this, it's like a jigsaw. A financial plan is like a jigsaw. If you did something in, let's say, retirement planning, that could directly influence something in estate planning. For example, putting money into a pension could take it out of the estate for inheritance tax if that was, depending on the client's priorities. And, that could, doing one thing could influence both. So you could get a tick in a box if you put words along the lines of, by doing this will also affect your estate planning, by et cetera, et cetera. So this is where it all helps. And having this sort of helicopter approach almost, saying, I've got all these bits to join together. I may not be able to put enough detail into every single one because of time management, but at least I can get some ticks in boxes.
Yes, yeah. And if you can pass most of the sections and then
Indeed.
You know that you're not going to pass perhaps the last one or two, but you can still pass most of it, and then it relieves the pressure for the second assessment, because let's not forget,
Absolutely.
You get 3 submissions in total, don't you, before you need to start again with a new case study.
Yes. So in other words, the less you've got to do on the second or subsequent submissions, the better.
Yeah.
But as I say, this isn't real life. This is a case study. And it's about getting enough points to pass the various sections and enough points overall.
Yes, yeah. And some of the case studies that I'm seeing recently, there's an overlap between the protection element and the estate planning section because the clients are not married.
Yes.
Some of them are siblings, and some of them are cohabiting, but not married and have said that they don't intend to get married, happy as they are, all of those kinds of phrases.
Yeah, so don't make an assumption that they will.
Yeah, so don't marry them off.
Yes.
And actually, things like taking into account when you're doing the projections, assuming one of them dies today, then you've got to think down the line and take off the deduction for inheritance tax that would be paid. That is impacting not just in the estate planning section, but actually will impact in, the protection and personal risk section too, won't it?
Absolutely, and possibly retirement as well, depending on the scenario and how the plan is structured. Yeah.
Yeah, so there's lots. I always describe it as like a giant 3D jigsaw puzzle. And, people often say to me, oh, Jackie, do I have to meet all the objectives? I mean, particularly going back to retirement planning. I think retirement planning might be my second favourite subject after assumptions now. But people tend to, run out of time and, don't think it through. And then you kind of think, well, if you spend too much time writing up your retirement planning section, then you and too much space, because you've only got 60 pages in total now, haven't you? And the font size and paragraph size is prescribed by the CISI. So you can run right out of a number of pages if you don't, I guess, having your skeleton plan, if you like, would be a really great start to stop you running out of pages, because in some situations, you kind of have to write it backwards a bit, don't you?
Yeah, and it's this thing about it's not a suitability report. This is not designed for compliance. So consequently, if you're coming back to your point, if you've got to start with the skeleton, you flesh it out and you put all this data in there and you end up with 100 pages, and in the old level 6 days, I think the biggest one I saw was about 160 odd pages. And
Yes.
it was just incomprehensible. No client would ever have followed it. And I really struggled to follow it. And I think they failed in the end. If you start with the skeleton, you start filling out the gaps. If you then find you've got 65, 70 pages, it's easier to take stuff out.
Yes.
As long as you've still got the clarity with everything we've already talked about.
Yeah. Now, there were two things that have popped up recently since I stopped assessing. I don't know whether you saw any of this. And the assessors have issued recently, obviously after you stopped, an indication to the training providers to say that they would like to see candidates take into account the client's capacity for loss in their analysis.
Right.
So it used to be that we just essentially used to take into account their attitude to risk and set the asset allocation, then set the composite rate of return, deduct our costs and inflation, and then just kind of get on with it. What sort of issues have you seen that might make the current assessors say something like that?
Again, it's clarity, I think. Obviously, capacity for loss has been a fairly prominent issue with the regulator over recent years. There's been an awful lot of debate within the industry and within certain groups on LinkedIn, etc., around exactly what capacity for loss is. I think for a lot of advisors, it's still a tick box exercise on the back end of a risk profiling questionnaire, whereas a lot of planners, quite rightly in my view, are saying, well, no, it's a calculation. In terms of the assessment, all I would expect to see, or would have expected to see, would be an acknowledgement of capacity for loss and how that interacts with the risk profile side of it. And it's very difficult to, bearing in mind everything we've just said about the page limit and word limit, etc. It's very difficult to do an awful lot around capacity for loss, but it needs to be recognised that it is an issue, and not only a generic paragraph on what capacity for loss is, but then perhaps referencing it once you've done the calculations, you've done the projections and the spreadsheets. Yeah.
And I think capacity for loss, it could potentially impact whether you choose a drawdown route or an annuity or part annuity route, couldn't it? I guess if you've got a client, who is very loss averse, who has no capacity for loss, then essentially that should steer you away from, full on drawdown.
Yeah, it will, but bearing in mind where annuity rates currently are, it also makes your job harder if you go down the annuity route. But this is the dilemma when you put the plan together where you haven't got a client you can talk to about these sort of things. Yes. Again, there is no absolute right answer. However, you need to show you've considered it. And again, it doesn't have to be one or the other. You could do part annuity, part drawdown, for example.
Yeah. And I can remember, I think it was it partnership? And I think they were saying that there was quite a lot of evidence out there that having a base level of expenditure protected by an annuity for clients in real life actually gave them a lot of comfort, so they could pay their own bills. They knew exactly where they were going, and then you had the drawdown for kind of all the extras, the holidays and presents and trips out and that kind of thing.
Yeah, indeed. And bear in mind the fact find lists all of those things in the various areas as well. So you've got the numbers on which to base an annuity quote, for example. And it comes back to what we said earlier about protection and health. If you've got a couple and one party is unhealthy, well, they may be the one you look at for drawdown for annuity.
Yeah, absolutely. Now, we are coming to the end of our podcast recording today, but there is just one more question that I wanted to ask you, Gareth, and that is the practicalities of whether candidates should assess their own plan and how they could go about doing it, because they've got the assessment standards, the assessment criteria. It's exactly the same criteria that the assessors themselves are given. There isn't anything extra or hidden or anything like that, is there? So how would you recommend that candidates go about assessing their own financial plan before submitting it?
I think it very much depends on the individual. two reasons. One is experience, and the other is self-honesty, if that's the right phrase.
Mm-hmm.
If you can be self-critical, then absolutely do it yourself. You'd mentioned, I think Joe mentioned in one of your previous podcasts about putting it in a drawer for a week and then going back to it because you do come at it with a fresh set of eyes. Absolutely do that. If you've got the time to do it, absolutely do that, because you will see different things. It depends on the environment you're working in as well. If you're working with other planners, and I do mean planners, not advisors, people who are used to producing a financial plan, then you can get help from them. But it's being honest with the criteria and not saying, oh, yeah, that's enough. I think I've done enough for that. Be very, very critical. But again, I know you've said this before, this is the only qualification where you're given a very comprehensive fact-find set of interview notes and then told exactly how you're going to be assessed on it.
Yeah. And
you can literally tick them off. But you have to, that's what I mean about the personality of the individual. You have to have that ability to be self-critical. And get a mentor. I was fortunate I had people around me when I did my CFP all those years ago. And I've helped mentor other people since. And it does make a difference as long as your mentor is brutally honest.
Yeah, absolutely. Yeah, great tip.
Or get a very good trainer, which is obviously the answer I think you were fishing for. So. But in all seriousness, I absolutely recommend that. If you've not got that environment around you where the expertise is there and the honesty is there to help you, it will save you time and money by having someone like your good self who knows what they're doing to help you through it.
Thank you. That's very kind. And on that note, we will leave it there. That
wasn't intended as an answer. Yeah.
Gareth, thank you. It's been an absolute pleasure to talk to you today.
Oh, it's been lovely to speak to you too, Jackie.
I hope you enjoyed today's podcast. It's really interesting, isn't it, to listen to other people's points of view about different things, all relating to our wonderful financial planning profession. If you know anyone who might be interested in listening to any of these podcasts, please pass on our details to them. So that's it from me. Join me again next time when we'll be talking all things certified financial planner related and also dropping in on our new entrants to the financial planning profession. Bye for now.